When investing for the future, every dollar of tax saved boosts your total return. More money stays in your retirement nest egg and less ends up in the ATO's pocket. That's where salary sacrifice into superannuation becomes a powerful strategy. It allows you to invest in a tax-effective way, generating a dual return. The immediate tax saving today and a long-term wealth accumulation in a low-tax environment. In this video, we're going to break down how it works. Salary sacrifice is where you direct part of your pre-tax salary into superannuation instead of receiving it as part of your take-home pay. This strategy reduces your taxable income and allows more money to grow inside the low-tax super environment. These contributions are taxed at 15% inside super rather than your personal marginal tax rate, which can be as high as 47% when the Medicare levy is included. The tax saving comes from the difference of your marginal tax rate and the 15% super rate. Salary sacrifice is a type of concessional contribution, which counts towards your annual concessional contributions cap. For the current 2025-26 financial year, the concessional cap is $30,000. Contributions which count towards your concessional cap limit include employer contributions, salary sacrifice contributions, and personal deductible contributions. If you exceed the cap, you may be able to utilise unused carry-forward concessional contributions from previous years. That is, if your total super balance is below $500,000 as at the 30th of June of the prior year. Otherwise, excess contributions may attract additional tax. Now let's look at a case study. Kriss is an office manager earning $140,000 a year. She decides to salary sacrifice $1,000 per month, that's $12,000 per year, into her superannuation. This table outlines the difference between her current arrangements and the proposed arrangements which include the salary sacrifice. Under both scenarios, her gross income is $140,000. However, under the proposed scenario, she decides to salary sacrifice $12,000. As a result, her personal tax payable will reduce from $35,938 to $31,748. In terms of her superannuation, her employer contributions remain the same under both scenarios at $16,800. However, again, in the proposed scenario, she has a $12,000 salary sacrifice. This increases her contributions tax from $2,520 to $4,320. Down the bottom, we have the net difference. So under the current scenario, her total income plus net contribution is $118,342. Under the proposed scenario, it's $120,732. The total tax paid reduces from $38,458 to $36,068. This represents a tax saving of $2,390. In simple terms, by giving up $12,000 in gross income, Kriss ends up $2,390 better off overall, which represents approximately a 20% risk-free return. Each month she salary sacrifices $1,000, but her pay only drops by about $650 due to the tax saving. There are several reasons why this strategy is worth considering. Let's go through those now. 1, there's reduced tax payable. Salary sacrifice reduces your assessable income, which in turn reduces the amount of personal income tax you'll pay. 2, boosted retirement savings. By increasing super contributions, you'll have more money invested within superannuation for your retirement. 3, tax-efficient savings structure. Superannuation can be a tax-effective vehicle to save for your retirement, as earnings within your super fund are taxed at a maximum rate of 15%. 4, for savings plan, additional money is allocated to your retirement savings before you spend it. This creates a great forced savings plan, and eventually you will adjust your expenditure to account for the reduced income. And 5, employer incentives. In some instances, your employer may offer incentives to make voluntary contributions to your superannuation. You need to check your employment contract to see if any incentives are available to you. While this strategy has many upsides, it's also important to be aware of the trade-offs. 1, reduce take-home pay. Reducing your pre-tax income will lower your take-home pay. This means having less money available for living expenses and alternative wealth building activities such as paying down debt. 2, contribution cap limits. You are limited to how much you can salary sacrifice. As already mentioned, salary sacrifice forms part of your concessional contributions cap limit. If you exceed your cap limit, you may have access to unused carry forward concessional contributions. If not, tax implications will apply. Please note, if you are currently in an untaxed fund, the standard concessional contribution cap limits may not apply to you, so you need to seek specific advice. 3. Limited access to funds. Superannuation savings are preserved until you meet a condition of release. For most people, this condition is reaching preservation age and retiring from the workforce. There are some instances where you may be able to access the benefits earlier, such as release on compassionate grounds, financial hardship, or under the First Home Buyer Super Saver Scheme. 4. Understand your investment strategy and fee structure. Before putting any additional money into superannuation, you want to ensure you understand and are comfortable with the investment strategy and fee structure within your super fund. 5. Division 293 tax. For high income earners, if your combined income and concessional contributions exceed $250,000 in a financial year, you may face an additional 15% tax on some or all of your super contributions, totaling a 30% contributions tax. And 6. Legislative changes. Funds held in superannuation are subject to ongoing legislative changes. This risk increases the further you are away from your preservation age. Implementing a salary sacrifice arrangement is relatively easy. Simply discuss this with your payroll department and they'll advise you on the process to get it set up. Contributions will be deducted automatically from your gross income each pay cycle. If you're earning a decent income and want to grow your retirement savings in a tax-efficient way, well, salary sacrifice may be a smart move. You can get a tax break today and invest in your future at the same time. We typically consider a salary sacrifice arrangement in phase 2 and 3 of the wealth creation process. It's a simple, low-maintenance strategy that can make a big difference, especially when paired with other smart planning strategies. If you think salary sacrifice to superannuation is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.